Well, it's Rhonda Thomas, and we're about to do Financial Accounting's Chapter 1 coursework, where I do about up to six problems, and then you have the remaining uh, 3 or 4 to do on your own. Okay, so if you will do that, it gives you an opportunity to try out your knowledge and your concept skills and things like that. So I'm going to share my screen and hope that we don't get kicked out. All right. I also have my uh, Excel spreadsheet open. So before we start this problem on the accounting equation, I just want to review a couple of things. So once again, here at the top of my spreadsheet, assets, liabilities, equity. What I tried to do is put some of the common names for most of the assets you'll see, right? Anything is prepaid is always an asset. Under liabilities, so we got resource of value, something you can own, cash, accounts receivable, supplies. Sometimes that's referred to as prepaid supplies, land, vehicles, investments, anything you can pretty much sell to turn into cash is kind of another way to determine whether something's an asset. Liabilities are debts that must be repaid, involving a creditor, something you owe. Anytime the word payable is used in an account title, it is a liability. You can count on that. And anytime you see the word unearned, just like earned is for revenue, okay, which we're going to get over here to see here in a minute. Anything that's unearned means you owe the earning of it. So I'll explain that if we get around to something with that in it. Okay, so ignore the expense word here, pay attention to prepaid, ignore the revenue word here, pay attention to unearned. Equity, we've basically been dealing with 3 different accounts: common stock, retained earnings, dividends. Retained earnings is where net income or net loss is reported. Okay, and then dividends are paid out of retained earnings. And then revenues. Revenues must be earned, must be earned, must be earned. So you've got to do whatever you said you would do, deliver the product, complete the service. All right. And then finally, there's the expenses. Of all the accounts, this is the one that will have the most. Most of the time, it has the word expense on it. Here's one that doesn't. The cost of goods sold. We have not got into product inventory yet, but when we do, we'll start seeing cost of goods sold. Once again, if you see the word net, something's been subtracted. Prepaid is an asset, unearned is a liability. I can't stress that enough. Okay, here's that T account. The debit side is the left side, the credit side is the right side. If you see the word issued, it means sold. Dividends are payments of earnings to shareholders. Okay, so I want to show you the stockholders' equity T account. So this could be common stock, or this could be retained earnings. Okay, so it just depends, and I can put beside this one here, I'm going to put common stock or retained earnings. Those are both equity accounts with the credit balance, right? So this account, which goes clear over to here, has a beginning balance. And here is how you calculate a T account. You start with the beginning balance, you add any increases, you subtract any decreases, and you have an ending balance. So if you were going to look at stockholders' equity here, and I'm just going to abbreviate stockholders so we can see the title, then it has a credit normal balance, okay? Credit normal balance, which we'll go through the debits and credits in chapter 2, but the credit side has a beginning balance, any additional common stock issued. If you had net income, these are going to be the pluses to retained earnings, and it will have a normal balance of a credit as it's in balance. Anything that the two things that can make retained earnings go down. In fact, this is retained earnings. So let me take out common stock. Common stock is a different equity account, but it operates with the same credit normal balance. If you have a net loss, by the way, you can't have a net loss and net income at the same time. It's either one or the other. And if you pay out any retained earnings, those are called dividends, payments to owners. Okay, so let's get going. We're going to start on exercise 0107. Okay, and we've got a spreadsheet here. So do I. Captivating Inc. is a motivational consulting business at the end of the accounting period on May 31st, okay, of 02. They had, and I'm going to put in the assets here that they're telling me. Okay, so using the accounting equation, consider each case independently and determine the following amounts. So the first one is, what is the stockholders' equity on May 31st, year 2? So let's put in assets. So I'm putting that into my spreadsheet here. And liabilities are 2 million. Okay, and I've got a formula that takes assets and subtracts liabilities to give me stockholders' equity. Now I just put the word equity, so I don't want you to get confused. Yes, it's still stockholders' equity. I'm going to put 2,900,000 on here. You can check your work, right? Okay, now we're going to watch what the changes will be in year 3. Now notice we've got year 3 here, 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 and here. So each one of these scenarios are separate. Okay, they are separate. So I want to, we'll just work it as it comes. All right, so then year 3 for B, right? And I've got B right here. It says assets increased by 900,000. So I'm going to make this go up. Not 9 million. Watch your zeros. Okay, we'll take one of those out. 900,000. There we go. And then liabilities increased by 400,000. Okay, so 400,000 gets added, right? So if you make assets go up and liabilities go up, your equity now is 3,400,000. Okay. I'm going to go see what this Excel spreadsheet looks like. I like my spreadsheet better, but let's see what theirs looks like too. Okay, so we can do this also. So the amount to start off with, see here, assets are in, okay, so we've got to do some formulas here. Okay, we're going to take stockholders' equity as of year 2 equals assets minus liabilities, which is, there is that 2,900,000 that my spreadsheet says. Okay, so now how do we get to the new amount of equity based on, I like my spreadsheet better. So, all right, let's go to, we'll go ahead and do it, equals assets plus the increase right? And we need to put parentheses around it. Okay, if you don't have to do Excel, but if you're going to, it would be a good idea. So then we're going to subtract, because now we're going to calculate the new liability amount. Okay, liabilities are 2,750,000 plus 400,000. Enter. Okay, now that is, and then we need to put that there. Okay, and there we have it. Okay, so you say, how'd you do it? This shows you the formula. So we took C6, which is up here, C6, assets plus the increase, liabilities plus the increase, and then we made assets subtract the liabilities. That gives you the amount of the equity. Now, you have to remember that now here comes a brand new scenario. So I'm going to make this equal what I have here, because it's just doing it all over again. All right, so the next change is a decrease of 800,000 in assets. I like my spreadsheet better. That's right. And an increase in liabilities. Okay. So then the formula becomes equals, open parentheses, assets minus the decrease in assets, right? Minus, open parentheses, liabilities up here. Okay, we want this here. Liabilities plus. Okay, so our liabilities went up to 20. Okay, so hang on a minute. I am working on this formula. So we got the assets less the decrease in assets. Then we need our liabilities plus the increase. And then we need to put parentheses on the end. And actually, we probably ought to put parentheses around the whole thing. That might be overkill, but I believe that's how it's supposed to go. Yes. So this one truly needs a little bit more also. So I'm going to put parentheses around this because it really should be looked at as one number there, so that these follow each other, right? So that's how you do it. All right. So this next one is a third scenario. So I'm just making my year 2 equal what I put in. So we're back at 2,900,000 for equity for year 2. Now, this third option is an increase of $330,000 and a decrease in liabilities of $140,000. Okay, so now let's see if we're correct. Equals, open parentheses, one more parentheses, assets plus the increase of 330, close parentheses, minus, open parentheses, the liabilities, and we're going to make sure, yeah, and then it's a decrease, all right, in the liability, close parentheses, hit enter. Okay, so I put one too many zeros here. That's why it's not following this one. Okay, so there it is. And once again, you're trying to understand which direction things are going. This last one is, what is the net loss, right? What is the net income or net loss for E during year 3? So if you know how much the assets have increased. So, okay, equals. I want to equal what I have up here and what I have here. So here's where we're starting, right? Here's where we're starting. Oop, let me go back to put that back. Okay. All right. So instead of knowing what the changes are, we're going to just put in 7 million. Okay. That's what the assets are now. Okay. The liabilities are now 2.5 million. And that means that the new equity amount is $4,500. Okay. The new equity amount is $4,500. And if the only thing that caused equity to change is the net income, then we could solve for net income right here. Okay, so it's the change in equity. And so let me see if I can do this. All right, we're going to do equals. We're going to start with this. Okay, that is the amount of equity from the year before. Subtract, open parentheses, we're going to add the assets and subtract the liabilities to get the new equity amount. Okay, and then I think we'll hit enter. So, okay, it is $1,600. Let me see what I've done here. So F14 is the amount from the year before. Okay, let's start this one over. I got a better idea so we don't get a negative number. Equals. Let's start with what the current year is, which is year 3. We have assets minus liabilities, close parentheses, less the amount of equity from the year before. There we go. 1,600. 1,600 is the net income. Okay. This is the change. This is the net income because that's the only activity that happened in that year in equity. Okay. There was no common stock additionally issued or dividends were not paid out. Okay. Now we're going to take these amounts that you filled in and we will close this Excel file because we're finished. And I've got our numbers over here to put in. All right. So C's new equity amount based on the information there is 1,880,000. Okay. I can see everything I want to right here in this spreadsheet. Okay. B. So when we took assets going up, liabilities going down, what's the new stockholders' equity for D? 3,370,000. Okay. And then instead of adding or subtracting, we know this is an addition. We know this was a subtraction because it went from this amount to this amount. They told us the new balance. So you add those two together, there's what equity becomes. So equity, year 3's equity of 4,500,000. And if you subtract the beginning equity or the ending equity for year 2, you get the difference of 1,600. So it's net income of, well, I'm sorry, 1,600,000. I'm not used to dealing with such big numbers on a personal level. Okay. So, all right, I think we got it. Let's check it. Now, this is kind of complicated, but once again, because of a spreadsheet and some formulas, and once you start using them, you won't want to stop. Okay. And once again, the change formula, if you ever come across a formula for change, it's the new minus old. Okay, so once again, here's the new minus old, and there's the change, and that is the net income. So this is the change in equity But I told you sometimes they may ask you to find change in equity. Okay, so we have to be ready for that. Okay, let's do, what's next here? Just a second. Okay, we're going to go to 12. Okay, I don't have 12 on here, so I'm just going to help you with this one. So the following selected transactions were completed by the United Delivery Service during the month of February. So indicate the effect of each transaction on the accounting equation by choosing the appropriate letter from the following list. Believe it or not, these are your only options. Okay, these are your only options as far as putting in transactions. It may seem like there's more than that, but if you put the 5 elements, actually we're working with the 3 elements right now, the 3 classes of accounts in chapter 1, which is assets, liabilities, and equity, then every transaction is going to fit into one of these 5, right? So receiving cash in exchange for common stock. So cash goes up, so that's an asset increasing. Okay, and the asset increasing and an increase in stockholders' equity. Yes, so C is the answer for that one. Okay, purchase supplies for cash. So we're getting supplies and we paid cash. So that's an increase in an asset and a decrease in another asset. It's an increase in supplies and it's a decrease in cash. So it's A. Paid rent for February, $4,500. So rent is an expense, and an expense causes a decrease in stockholders' equity. It also is a decrease in cash when you pay something. So this one is E. Okay. Paid advertising expense. That's going to be the same thing. It's an expense. Expense causes equity to go down. Don't worry, in chapter 2, we have revenues and expenses as their own category of accounts. So this is E as well. Receiving cash. Receiving cash is an asset going up. So it's one of these 3. And we did a job. When you do a job, you earn revenue. So just like expenses causes equity to go down, revenue causes equity to go up. So this is C. Okay. Build customers. Remember when you bill customers on account, I suggested that you memorize the fact that that's accounts receivable. Accounts receivable is an asset. So that's an asset going up, right? And we did some services. And when we get to bill those customers, that means we've earned the revenue. So revenue causes stockholders' equity to go up. So this one is C also. Okay. Paid creditors on account. So paying causes a decrease in an asset. And if we're paying down a creditor on account, then that means we are lowering the liability by paying some of it off. And so it's a decrease in an asset and a decrease in a liability. That's D. So I think this is the first time we're using D. Receive cash from customers on account. Cash goes up. That causes an increase in an asset. And who did we receive it from? Customers on account is accounts receivable. So when customers pay us, accounts receivable actually goes down. If they're paying us, if we sent them a bill, when we create the bill, right? When we create the bill up here, billed customers for delivery services on account, we're creating the accounts receivable. And now those same customers are paying us the cash. So the asset's going up, but this asset, which is customers on account, which is accounts receivable, is going down. So that's an asset going up and an asset going down. So that's A. Two more. Determine the cost of supplies on hand was $300 and 15 of supplies had been used during the month. So used also means expensed. Okay, so there's only $300 left in supplies. So we're going to create an expense for that amount of the supplies that were used. Remember, an expense causes stockholders' equity to go down, and supplies is an asset. And if we use up some of the supplies, then that asset is decreasing. So we've got E as this one should be correct. All right, finally, this last one, paid cash dividends. Paying cash causes assets to go down, and dividends are not an expense. Dividends cause retained earnings to go down. So we have a decrease in an asset and a decrease in stockholders' equity. So this is E. Okay, let's see if we're right. Okay, we've got to watch the key words, received and on account, paid and on account. Okay, we're trying to get you used to the vocabulary used. Okay, let's move on. Okay, that one, number 12, we did together. So this is an algorithm problem. And we've got that accounting grid going across. Once we get past chapter 1, we'll be done with these. So this is the month of July. We've got a catering service. We've got 3 assets, cash, supplies, and land. We've got 1 liability. Common stock and retained earnings are the equities. And, okay, so these 3 are your equities. Here's the fees earned, and they've lumped expenses all into one category, one column. So they don't break out the expenses. They don't itemize their expenses. Okay, so let's see what they want here. So we're looking at transaction 1. They want us to, is it a drop down? Yeah. Okay, so they want us to describe what's going on here. So cash came in. So what else went up? I'm going to make this a little bit smaller. If I can get it across the screen, that would be nice. So we received cash and we're recognizing the revenue. Okay, so this is a cash sale. Okay, so this is provided catering services for cash. So cash went up, and remember, we're a catering business, so we recognized the service fees earned. Number 2, it looks like cash is going down, and it looks like land is going up, so we purchased some land with cash. So payment of cash, purchase of land for cash. There we go. Number 3, down goes cash for $24,800 and an expense is created. So we are paying cash for expenses. Okay. Number 4, down goes supplies. I'm sorry, up goes supplies. So we're getting supplies on account. Okay, we didn't pay the cash for them yet, but we're getting supplies. So purchase of supplies on account is the way that one will read. 5, select the description for transaction 5. So down goes cash, and we're recording dividends. So it looks like we're paying cash dividends to the owners. Okay, so paid cash dividends. They may not finish that out. Sometimes your description is pretty short. Okay, number 6, down goes cash and down goes accounts payable. So we're paying cash to some of our creditors, right? Because we had 7,700, we added 1,400, and now we're paying down on some of the liabilities that we owe. to our creditors. So a payment to creditors, payment of cash to creditors. This last one, oh, I'm sorry, there's a few more here. Number 7. Okay, number 7 is supplies going down, and we're recording an expense for it. So that's expensing the supplies and making the asset go down. So this is recognition of cost of supplies used. I really don't like that statement. I say recognize supplies expense and lower your supplies asset account, but that's all right. So the next question then is, we had $28,500 in cash, and now we have $14,000. So cash at the beginning of July was more than what we had at the end of the July. So what is the net decrease in cash during the month? So the difference between these two, okay, so let me see if I can find a spot to put this down here. Okay, just so that we can, so if you take 28,500 and subtract 14,000 from it, okay, equals the difference in cash is $14,500. Okay, so it went down, and they said just to enter it in as a positive number. Okay, what's the amount of the net increase in stockholders' equity during the month? So stockholders' equity includes these. What is the amount of the increase in stockholders' equity during the month? So we want stock, common stock, retained earnings, and dividends. Okay, so let's go ahead. We're going to use all of these. So 30,800, that didn't change. Retained earnings didn't change. So the month of July, and then we paid out some dividends. So it looks like the net increase, because that is the balance there. So that's at the beginning. What is the amount of the net increase in stockholders' equity during the month? Then we also would want to look at the fees earned and the expenses. So there was no increase in these. So let me take those out, because what this was at the beginning is what it is at the end. So there is no increase, but we need to find net income. Okay, net income is going to be your fees earned minus your expenses. And we do have two expenses. So we're going to take revenue. Okay, so let me put this down. So this is explaining the net increase in equity. Okay, so we're going to start with revenue. Revenue is $33,300, and then we're going to use expenses. We're going to subtract those. Okay, so here is your net income. Net income is $5,600. We paid out some dividends. Okay, and then we're